Good afternoon, everyone. Thank you for being here today, and thank you, Mr. Kim and Mr. Charlie Lei, for your time to conduct this guest lecture session. Today, Mr. Charlie will share insights and discuss the economic outlook post-COVID-19 with moderation by Mr. Kim. Regarding the schedule of this webinar, we will begin with a keynote speech delivered by Mr. Charlie Lei, followed by a question and answer session, and close with a photo session.
Before we introduce our guest speaker and moderator, we'd like to go over the house rules. Firstly, please change your names to your student ID and full name. And to prevent distractions, keep your mic muted but video on throughout the keynote speech. During the Q&A session with Mr. Charlie, please write your questions in the public chat box or privately ask the committee if there are any questions directed at us. You'll also have the chance to win 10 GoPay vouchers worth 100,000 each. So if you participate in this session and ask good questions, so do keep that in mind.
As our guest speaker, Mr. Charlie Lei is a senior economist who specializes in Asia and is based in Singapore. Having worked in various private and investment banking capacities, he has a broad range of experience in Asian and G7 markets. Mr. Charlie has been in its field since 1997, with roles such as regional economist in Societe Generale and FX strategist in Credit Suisse Private Banking. He began his career with the Australian Treasury in Canberra in macroeconomic modelling, responsible for forecasting and modelling the Australian economy. He currently holds a master's in economics from the Australian National University.
This webinar will be facilitated by Mr. Kim as moderator. Mr. Mike Kim is a lecturer and content coordinator at the International Business Program in BINUS University International. He has more than 13 years of industry experience in consulting services, manufacturing, and finance, and have worked in more than 5 different countries. He's a graduate of Yonsei University and currently a PhD candidate at Singapore Management University. Furthermore, he sits on several boards of directors in Indonesia, Vietnam, and Hong Kong, as well as being an advisory member of various associations and government bodies. So without further ado, I'd like to invite Mr. Charlie Lei to speak and share his screen.
All right. Thank you very much, everybody. Thank you for joining us, and thank you, Mike, for your kind invitation and university for extending this invitation to me. So what I'm going to go through with you, I'll go through with you, say, the broad macro backdrop, where we are in sort of the global economy, and maybe a few implications, what that means for the markets and really just for the outlook. So I'll talk for about, say, 40 minutes or so, and then after that, we can have a bit of a Q&A. All right, so let's start. So we'll cover these topics, global backdrop, we'll look at the COVID shock, we'll look at the Fed, which is the US Federal Reserve, right? We'll look at China, ASEAN in general, and then importantly, let's take a few minutes to look at the US-China relationship. And then, of course, in any analysis, we'll always look at the risk. Okay, we'll just finish off with that. Okay, so here's the, I'll try to talk slow. So if I talk too fast, Mike, feel free just to pin me and I'll slow down a bit, okay? So let's start over this chart at the top here. The black line here is the US growth. The orange line is global growth. Now, when you read about global growth in the newspapers and the media and all, have these two numbers at the back of your mind, 2 to 4%, right? Anything below 2% is global recession. Anything above 4 is really, really strong growth, robust growth, right? So global growth will not be below 0, right? Because you're always going to have about 1% population growth and about 1% productivity growth, right? So even people do nothing, the global economy should grow at least by 2%, right? So look at this table. Last year, the global growth contracted by 3.5%. So way, not just below 2, but below 0%. So this year, by default, you're going to expand, because you're coming off of a lower base. Now, the US economy is the world's largest, around almost 25% world GDP. So where the US grows is really where the global economy will grow. The next biggest sort of region is the Eurozone. And then the next biggest country is China. Now, interestingly, you look at this table here. In 2020, China was the only major economy that managed to grow, right? 2.3%. That's even though the virus sort of came out of Wuhan or China. But the fact is that it managed to grow because they managed to lock down the economy and help the economy to recover very fast. So even before the vaccine came, okay, so a few points here to note. Number one, I think that's, okay, number one, now when we talk about a bull run in the markets, it just means the stock market just keeps going up, right? Without correcting more than 20%. Anything below 20%, we say that's bear market territory. Well, for the last 10 years, from the global financial crisis up until 2020, the market was just relentless, right? Going up year after year after year. Everyone knew it was overvalued, it was too expensive. Then all of a sudden, COVID struck, then bang, the bull market sort of came to a halt rather rapidly. But the surprising thing was that the bear market lasted very, very short, only a few months. And then it basically rebounded really fast. And the reason for that is because of the Federal Reserve. In fact, not just the Federal Reserve, but all the central banks in the world, they basically pumped in a lot of liquidity. Okay, so we talked a bit more about that a bit later. Okay, second thing that you need to know, as a big backdrop is this thing. A crisis merely accentuates existing trends, right? So what does that mean? That means you have a trend that's going on. Whenever you have a crisis, it basically continues that and maybe even a more forceful rate. For example, number one, I have a few things here. Number one is digitalization. How many of you know digitalization has been occurring for the last 10 years, right? But it's only in the last few months because of COVID lockdown, right? It basically took off, not just in health, in education, but really across the board. For example, a case in point is education, right? Look at this. You can basically do Zoom, hold your classes, etc. Number two is deglobalization, right? So, the last 70 years, since the end of World War II, you can say globalization is synonymous with Americanization, right? It's basically America that's been driving the global economy. But since Donald Trump came to power, what did he embark on? He embarked on a scheme of protectionism, trade war, etc. So everybody was looking to revamp the supply chain, right? Rejig the supply chain, to reorganize. Not to have long supply chains in the cheapest place like China, but build a bit more resilience. So this deglobalization it's started during the Trump years. COVID is probably just accelerating that. And especially point number three is the revamp of the supply chain. Okay, what about this number four? A winner take all mentality. And you know that really, really clear during the COVID lockdown. The big companies that were allowed to stay open got even bigger, right? Were even more profitable. But the small companies, your mom and dad shops, were forced to shut down, right? What about income inequality? That's been continued for the last few decades. And in a sense, COVID has accentuated that. The rich got richer and the have-nots have even less, right? The social fractures. Now put here Trumpism. Mr. Donald Trump is no longer president, but Trumpism, what it stands for, is still very much alive, okay? The US-China tensions, of course, is even worsened with all the finger pointing, right? Where it came from. What about this last point here, point number three? It's going to be an uneven recovery, as you know it already, right? The developed world with access to vaccines are going to recover even faster. But this whole idea about the tech revolution, have you heard about people talking about the fourth industrial revolution, right? IR4. And what is that built on? No longer on electricity or machines, right? Or even the internet, but what is it? It's about AI, robotics, big data, renewables, right? New materials, 3D printing. These are all game-changing sort of technology. So those countries which on the forefront, it's just going to benefit even more. Okay, so that's a big sort of backdrop where we're at. The best way, if I look at this, the best way that you can make sense of the crisis, the COVID and the recovery, is think of the COVID as a series of 4 shocks: a supply shock, a demand shock, a COVID shock or a health shock, and a financial shock. Okay, so let's go through this in detail. So you see, but you say, what about a financial shock? Well, that didn't last long. I'll tell you why. Okay, first one, in terms of the supply shock, IMF called this recession as the Great Lockdown Recession, right? There's a famous treasurer prime minister in Australia many years ago by the name of Paul Keating, if you guys remember. And he made this statement one time when the last time Australia had a recession, which was way back in 1990 or so, where he said, this is the recession Australia had to have. But in a way, the global recession that we just went through was the recession the world had to have. Why? Is to protect people's health, to protect people's lives, right? Because we didn't know what COVID was all about. So the best way was to stop human interaction, okay? So supply shock means the global economy came to a halt, sudden halt, okay? What it's gonna, of course, things are better now with the vaccine, etc., but the shock that he has created is going to be persistent, right? And what is that? The revamp of supply chain. In fact, this already began under Donald Trump. Remember when he started the trade war, right? But with the COVID shock, it's basically caused a lot of corporations, especially American MNCs, now to rethink this whole idea about efficiency. Now, what was the thinking in the last, say, 20 years? If there's one episode in the world that changed the face of globalization, of global trade, it's in 2001. What happened in 2001? We all remember what happened 9/11, right? The terrorist attack. But very few people will remember the significance of 12/11, December 11, 2001. What happened? Is when China joined WTO, right? Then what happened? Basically, all the American corporations wanted to produce at the cheapest location possible. And where was that? And that was China, right? So they basically went to the cheapest location and had the most efficient supply chain, okay? In fact, this statement here by Tim Cook, he said one time that inventories are evil, meaning that they're costly if you want to hold a lot of inventories, right? So if everything goes well, the best policy was just to have the cheapest, lowest inventories, the cheapest supply chain, cheapest production, etc. All this is okay until you have a shock, a disruption to the chain. And that's what COVID has done. In fact, that's what the trade war has also done, right? So now the corporations beginning to think like this instead. Instead of operating at the efficiency frontier, the most efficient sort of possible way that you can produce, you got to build a bit more resilience into your supply chain. That means what they call build a bit more redundancies, carry a bit more inventory so you have a bit more resilience, right, to shocks. So this is really the supply shock, and that's going to continue. Okay, so globalization may not reverse altogether, right? But it's not likely to grow at the same pace as in the past, say, 20 years or 30 years. Okay, so that's the supply shock. Next one is the demand shock, right? People stay at home and can't go out in restaurants, they can't spend, etc. So this red line here is just, and the yellow line is just the US unemployment rate, right? The red one is what they call U6, which is the underemployment. U3 is the unemployment rate, the usual measure. So you can see how it shot up in about March, April last year. It's come down a lot, but still above the pre-pandemic levels, okay? What helped a lot, besides the vaccine before that, is really all the stimulus that the government has pumped in, especially from the US side and even on Indonesia side, right? So that's a demand shock. So slowly, the economy is opening up, at least on the US, right? Here in Asia, slightly different story. Look what happened to Malaysia over the weekend, right? They announced another full lockdown, right? It's really back to April last year. So that's demand shock. And then the health shock, as you all know, is about the COVID. And with a health shock, you need a health solution. And fortunately, the scientists have come up with a vaccine in quick time. Okay. Now, the Biden administration had this aim: 100 million vaccination in the first 100 days. They managed to do it in just 60 days. And now they managed to inoculate even 200 million people plus already. So almost 60% plus of the American population already vaccinated, right? So they're basically on the road to recovery, but the rest of the world, especially Asia, is a different story. Emerging markets, especially. Okay, so a health shock, you need a health solution. There is light at the end of the tunnel, but it's still a long, long way to go. Why? Because until all the world is vaccinated, the US will not be safe. Europe will not be safe. Because you know what? One of the things I say about the virus is that as long as it doesn't replicate, it will not mutate. And what are people worried about now? They're worried about mutation, right? Like in Vietnam last week, they said that they're worried about a combination of two variants. What are they? Of the Indian variant and also of the UK variant combined together. So in order to stop mutation, you need to stop replication. Okay, so that's basically what they need to do now, is to inoculate the whole world. Okay, that's a COVID shot. So here, you look at this chart of Asia COVID cases per million. So the green line is India, right? So they were able to handle it reasonably well in the first wave. That is the second wave, it really shot up. Thankfully, they probably passed the peak and sort of coming out. Although you probably have to say, the actual numbers reported probably way underestimate the actual numbers. By how much? Probably by 5x or 10 times, 10x more than what is actually reported, right? But at least if you believe these numbers, at least take the past the hump, as opposed to the purple line, which is Malaysia, right? It's really shot up again in the last 2 months. So that's why they've gone into lockdown. So you're going to have this bumpy sort of recovery. Now, Indonesia is the red line here. Hey, not too bad, right? But you guys probably know better what's happening to the situation, whether it's safe to go out or not. Okay, so in Singapore, our Prime Minister is going to make an announcement at 4 p.m. later. Probably going to relax things just a little. Okay, this next chart is just on the inoculation in the world, but never mind. You see how Malaysia, Indonesia, Asia basically lagging behind your UAE, Bahrain, Israel, and also on the US side. Okay, let's go on to the next slide. Now let's talk about the Fed. Okay, like it or not, the world revolves around one central bank. And who is that one central bank? The US Federal Reserve, because it's the largest economy that control US interest rates, the dollar, that basically control global finance. Whenever the Fed hikes interest rates, the dollar appreciates, everybody will be in trouble. If the Fed cuts interest rates, does a lot of quantitative easing, pumps the world with liquidity, the dollar weakens, a lot of liquidity out in the world, everybody rejoices, everybody is happy. Okay, now, so that's a general sense. Yeah, this chart captures what we call the VIX index, which is a volatility index, right? The black line is the volatility of the stock market. The gray line is the volatility in the bond market, okay? So it's basically measures volatility. Look at this chart. In 2008, the bond volatility and the stock market volatility spiked up. During the COVID crisis, the volatility, especially in the bond market, did not go up as much as during the 2008 crisis. Why is that? That's the question, right? Because the reason why it didn't go up so much is really the foundation why the global economy, at least the stock market, was able to recover rapidly. Now, how many of you know this pop group? I don't think any of you would know. Mike will probably not know too because it's too young, right? You know the song probably, Video Killed the Radio Star. Video Kill, you remember the song? Okay, you go YouTube and you search it out, right? Here's my question. What killed volatility in the stock market and in the bond market? The answer is the Fed with all its liquidity that they pumped into the economy. Okay, let me show you. Okay, don't worry about the numbers above. Let me show you this chart. The red line is the U.S. stock market, the S&P 500 index, right? From March 2009 low, and then here's a COVID shock drop, and then it rebounded really rapidly. The yellow shaded area is the Fed's balance sheet. You know, what's the balance sheet? It means if I pump in more liquidity, I buy more bonds, basically, right? I put liquidity out there, my balance sheet will balloon, will get bigger, bigger, bigger. Okay. So last year, the US economy contracted by 3.4%, but the stock market went up by 16%. Wow. I thought the stock market is meant to represent the economy. Not really, right? The stock market represents the amount of liquidity out there running around in the economy, excess liquidity in the economy. Okay, let me show you these numbers, okay? In December 2008 to December 2014, the US Federal Reserve's balance sheet went up by $2.3 trillion in 6 years, okay? 2.3 trillion in 6 years. But last year, in just 3 months, from February to May, the Fed's balance sheet went up by 3 trillion. So in other words, they did 3 trillion in 3 months, but it took 6 years to pump in 2.3 trillion. Wow, amazing. So there's so much money that's been pumped into the economy. That's right, interest rates are record low, right? So that explains why the economy, the stock market at least, has rebounded really fast. Question for all of us who study economics, right? Question. Is there a price to pay for all this money printing? Your answer is, it depends, right? Depends on what? Depends on your time frame. In the short run, you say, no, maybe not. Everything's okay. But in the long run, maybe there is a price to pay, right? In what sense? Inflation, higher taxes, etc. Okay, so that's the fact. Okay, here we go. We talk about the consequences, right? What's the consequence? Let's look at 3 consequences of all this liquidity injection. Okay, all of us have been waiting to watch this movie, right? No Time to Die. The latest James Bond movie was meant to come out in April 2020, but it's been delayed again, okay? It refers to the bull market in the stock market, right? It just doesn't want to die because of all the liquidity. Even when it collapsed a lot, it rebounded really, really fast. Now, I put a few acronyms here, right? FOMO. What is FOMO? If you have teenage children, you all know what FOMO is, right? It's the fear of missing out. Because everyone's afraid to miss out, then they also jump into the market, take on more risk, and the market keeps on going up. Nope, it seems to work fine, okay. What about Tina, right? There is no alternative because bond rate, bond yields, everything, interest rates are so low. You leave your money in the bank, you really don't get anything. So you're forced to take on more risk, right? Because of all this money printing. What about BOD? It's very much a buy on dips kind of tone still, right? Whenever the market corrects, people jump in and buy because rates are so low. But there will be a price we could pay eventually because valuation is so rich. Okay, let me show you. I just show you very, very quickly. Okay, let's just look at this chart here. This is the PE ratio, but the cyclically adjusted PE ratio. So the price earnings ratio. When price earning is high, we say that it's expensive. When it's low, we say it's cheap, right? So for example, this is the US S&P 500 index. Where is it now? In March this year, it was around 35 times, right? In January 2020, it was 33.9 times. So even more expensive compared to last January. So this is the third most expensive after December 1999, which is before the dot-com bubble burst, and in September 1929, which is before the Great Depression, right? So it's the third most expensive in its history. So it is quite expensive in that sense. Just, okay, here's a point. Just because it is expensive, does that mean it has to correct to be more reasonable or cheap? Answer, no, not necessarily. It needs a trigger, okay? What would the trigger be? A geopolitical shock, maybe inflation shoots up, things like that, okay? So that's the first consequence. The markets are very, very expensive, okay? Number two is this whole idea about Wall Street against Main Street, right? The stock market against the people running real businesses, right? Because what you've seen here is really a dichotomy, right? The stock market has rebounded, but the economy hasn't really recovered all the lost jobs due to COVID. In fact, if we go down to specific parts of the economy, some sectors are still suffering. What are they? You can guess. Aviation, hotel, tourism, F&B, etc. Whereas those sectors which are benefiting from all the liquidity, they've done really well, okay? Tech stocks, etc. Okay, so this thing to note, the K-shaped recovery. What is the K-shaped recovery? It displays how some sectors, in fact, some economies, some regions are doing much better than others. For example, number one, the developed world against the emerging markets, right? Emerging markets including like Asia, Latin America. Second point of this K is that within economies, there's also a K. For example, the big firms are doing well, whereas small firms are suffering. The tech firms have done very well, as opposed to other sort of non-tech, right? Tourism, etc. What about the high income earners have benefited a lot more than the low income earners who basically depend on a wage? And more dangerously, it's also a K-shape in opportunities. Those who have access to technology, to education, will be even better equipped to handle the future. Let me show you this chart. This one is a chart on the wealth distribution in the US, okay? Let me just look at the red line here and the blue line. So the red line is the wealth of the bottom 90%. The blue line is the wealth of the top 1%, okay? So the top 1% own 35% of the wealth, as opposed to the bottom 90, only 28% of the wealth. And this is like almost the highest gap you've seen since 1929, right? Since before the Great Depression. What does this mean? It means that the rich are getting richer, right? Because they're owners of assets, owners of stocks, property, etc. Whereas the average man is just an owner of labor, and his wages have not gone up as much as, say, the stocks or the stock market, right? So it's that income inequality, the gap. So I guess that's one reason why with the new Biden administration, when they came in, they had to spend a lot, right, to pull up the bottom part. Okay, so that's the second consequence. The third consequence, let me just do it very quickly, is really on inflation, right? Because the question is the US government, the Fed, overcooking things, right? You get a porridge that's overcooked, right? That the economy will run too hot. And what's the problem with that? If it runs too hot, you have inflation pressures, right? So this is going to be very technical next chart. Maybe don't worry about this next chart. So it's the US 5-year break-even yield, right? That means what would the interest rate be on the 5-year bond yield, right? You just got to know it's going up, right? It's in fact the highest since 2008, which means the bond market is getting worried about inflation. Is it really, really worried yet? not quite yet, but it's beginning to be a bit nervous. Okay, so that's what. And what's wrong with that? Well, if inflation picks up, the Fed hike rates, it takes away liquidity, the rest of the world will suffer. Okay, so let me show you a couple of pictures of these two gentlemen. This is the debate. Okay, then I'll finish off this part, and then we'll try to finish up. Okay, do you recognize these two guys? The one with the glasses is Mr. Paul Krugman, and the one on the other side is Mr. Larry Summers. Krugman would say, not a problem, all this money printing, right? And he sides with Janet Yellen and Jay Powell, the Federal Reserve the chairman, right? It's not an issue. Whereas Larry Summers says there is an issue, what we call the bond market vigilantes. The vigilantes are like equalizers. You ever watch the movie Equalizer, right? Or Bring Justice, right? Because they say you got to pay a price for all this money printing. Who's going to be right? It really depends. Okay, so that's the science of economics. It's not a science; it's more like an art. It all depends. There's no straight answer. Okay, so but let me say, what do we think, right? You know, you got to know a lot of the bank analysts, sell side analysts. It's not good business if they say that there's going to be a crisis, right? So most people will say not really an issue, because then you can keep business going. But I say that in jest, okay, not too serious. But inflation risks are picking up, okay? But most people are not forecasting a big runaway inflation yet. So when it comes, there will be an issue. Okay, let me show you this picture here, and we'll bring it all together. Okay, then we'll move on to another topic. Now, how many of you know this pop group from the 1980s? A very famous pop group called Dire Straits. You remember this picture? They've got this famous song called Money for Nothing. Okay, you go to YouTube and you search it out, okay? It's called Money for Nothing, Get Your Chicks for Free, right? With all the Fed and European Central Bank, the Bank of England, Bank of Japan, all doing quantitative easing. They're pumping a lot of liquidity. Now, where does all this money go? It can go to 4 places, okay? These 4 places. Where are these 4 places? Number 1, it can go to zombie companies. What are zombie companies, right? Zombie companies are those companies that should be dead, but they're still alive. They're kept alive because of artificially low interest rates. So zombie company is a company whose profits cannot even cover the interest payments on its debt, right? So the Bank of International Settlements estimates that zombie companies are probably like around 15% as of like 2000, mid-2000, compared to only like 5% a decade or so ago, right? So they're going up. You said, what's the problem of keeping dead companies alive? Well, if you study economics, you come across this famous economist called Joseph Schumpeter, right? Where you get the Schumpeter creative destruction, that it's better to destroy something, which if it's not happening, and to rebuild it, right? So zombie companies are existing, but they're taking up valuable resources, which could have gone to viable companies, and they can create more productivity and sort of progress for the economy. Okay, so that's one problem. Okay, but that's a risk, right? If you have too many zombies, then your economy becomes unproductive. Okay, what's another problem with too much money? Well, what we said, asset inflation, right? And what's the problem with that? Well, not everybody owns assets, right? Not everybody has 10, 20 properties. But those who do, the value has gone up even more. So it could lead to a lot of social unhappiness. Okay, what about number 3? You recognize this logo, right? Quasi-financial assets will go up in value, like Bitcoin, cryptocurrencies, art, etc. Of course, crypto has corrected a lot already, right? But art, because money is going somewhere. What's the 4th level where it goes? It goes into spending, goods and services. And when people spend more, it will create even more demand. If there's not enough supply, then inflation will pick up. Okay. One other consequence of this is that if the country spends more than it exports, right? It imports even more. It has to import. Then a country's current account deficit will widen, correct? When it widens, it may lead to even more protectionist policies. So globalization might also come under threat as well. Okay, so these are just a pictorial way how you can sort of think about the risk of excessive money printing. Okay, let me talk on, say, 2 more topics, and then we'll talk about the risk, and then we can be done. So we've got about 10 minutes more or so. Okay, let's look at China first, right? Here's a picture of China. 2008 crisis, then the COVID crisis collapsed, then it rebounded really fast, right? One reason for that is because they locked down really, really quick, okay? Now, the interesting thing to note about China's response compared to the US and the rest of the world, this time around, they were rather reticent. They were rather hesitant in pump priming the economy, okay? In 2008, you know what a bazooka is, right? You know, like one of those bazooka where you fire a rocket. In 2008, they took the bazooka out and basically pump prime the economy, right? To save the economy. This time around, they didn't do that. The rest of the world did, but they didn't do it. So you look at these numbers, like fiscal plus monetary boost. In the US is around 44%, even more. China, only 15%. Average for the world, about 24%. Question, why did China not pump as much liquidity into the economy this time during COVID? Answer is because of rising debt, right? You just look at this chart, bottom chart here, total debt to GDP. In 2008, it was 139%, this number here. In 2020, it went up to 280%. So in terms of the actual numbers, it went from 6 trillion to 39 trillion. So China already added 33 trillion of debt as a percent of debt into its economy, right? The Chinese economy is only around, say, 16 trillion, so it's 200% of GDP. So because of a huge increase in debt, they can't afford to add another 200%. Otherwise, you'll really be borrowing too much, okay? And you'll be paying off interest. You'll be forever paying off interest. So that's why they did not want to go down that route, okay? So, but the economy still managed to recover because of the handling of the crisis. So that's one key point to know about China. Now, for the rest of Asia, you can split it up like this. The red line is ASEAN, okay? So ASEAN dropped last year. This year, we're forecasting 5.1, but the risks are really to the downside because of what's happening with the second wave, third wave of COVID, you know, Malaysia, Vietnam, etc. The gray line is China and India. So they're going to continue to perform well, although India may sort of drag it down because of the huge COVID cases. Now, the yellow line is the newly industrialized economies, right? We still call them that, of South Korea, Taiwan, and Singapore. Why are they doing so well? Because they contracted, but they rebounded. It's all because of the electronic sector. You know, there's a global shortage in the chip sector, semiconductors, because there's just so much demand for chips, right? So it's both a supply, underestimated production, but also demand. You know, where did all this demand come from? 5G, even your automobiles, right? Using a lot more electronics, telecommunications. So even across the board. So that's why these countries are rebounding faster. So this is just to illustrate that. Now for the rest, okay, this chart illustrates that the black line here is the US electronics new orders, and the yellow line is the top 5 Asian electronic exporters. So you see like a close correlation, right? So the black line, when it goes up, then the yellow line will pick up as well. So it just illustrates that point. Now for the rest of Asia, let's just look at Indonesia. Where is Indonesia? So the yellow line is the growth from last year, right? So most people contracted except three economies. Who are they? Taiwan, Vietnam, and China. whereas everybody else contracted. So this year, these three guys are going to continue to grow, and Indonesia contracted around 2% or more last year. We're forecasting 5%, but the risk could be even lower, maybe 4%. Now, let me ask you this question. Okay, 4% or 5% growth for Indonesia, is that good or average? Okay, is it good or not so good? Well, you say with 240 million people, if everybody does the normal activity, the economy will expand maybe by 3-4% already. So 4% growth is really not strong enough, not high enough. Indonesia can grow much, much faster, right? Not just through population growth, but through productivity, infrastructure. You can do a lot better. And that's the potential for Indonesia. What needs to happen? Well, in a sense, last year, there was a glimpse of it. A lot of more liberalization, maybe labor market reforms, investment in infrastructure, etc. Okay, so at least they're going along the same lines. COVID basically put a halt to it, a dent to this. This is just some details. Okay, so currency, okay, don't worry about the currencies. Indonesia rupiah, forecasting of this year, 14,600. Okay, more or less just slightly weaker, right? Okay, so that's the currency. So let's finish off. Okay, I got 5-10 minutes, right? 10 minutes. So let's finish off then. Let's talk about this whole idea about the US-China relationship, okay? Because I think it's important for you guys to know as well, not just know about the region, but the wider region here in Asia, because the US-China relationship is the most important relationship that will dominate not just Asian affairs, but global affairs for the many more decades to come. And one good way to look at it, take a step back and look at 3 different buckets. From China's point of view, the US point of view, and then the rest of the world, okay? So let's look at the first bucket. When Biden got elected, China basically made a statement that there's a new hope, right? There's a new hope that the relationship can be mended, right? Because Biden and Xi Jinping know each other for a long time already, back in when he was vice president. Okay, from China's point of view, number one, you got to know President Xi Jinping is a different Chinese president to his predecessors. The predecessors basically hold this view, especially Deng Xiaoping. Buy your time, hide your strength, right? Don't be outgoing. Don't display your power. But under President Xi, it's a different mentality. It's almost like this is our hour. This is our time. Okay. So number one. Number two, China will enter into a period what we call strategic silence, because they want to know what has changed from the US side after Trump. They really want to know these real quick, because they're here for the long haul. They really want to know these questions. What is the Biden administration thinking on Taiwan, human rights, the trade war, etc., right? Especially on tech. So they'll buy their time. So slowly, what is the picture that they're getting? The picture they're getting is, hey, it's a different president, but it's the same policies. The US is still going to go hard on China. Okay, you get that? And number three, China wants to know, what is the new administration's policy towards the one China policy? That means Taiwan. Okay, going to be a very sensitive issue. Number four, like we said, China is basically accepting the view. This relationship with the US is not going to go back to what it was before. The US is now more adversarial. That means more combative. They're not going to be nice neighbor anymore. They're going to be more assertive. Okay. Number five, China will also leverage off its economic power, right? Because 126 countries or more now have China as the largest trading partner. So if any one of these guys want to play punk, want to act funny to China, then China will say, okay, I just don't buy any more of your goods. Example, Australia. when they said they wanted to initiate an investigation into, or call for an independent investigation into the origin of COVID, what did China do? Put up tariffs on Australian wines and other exports. Okay, so and then Australia will suffer. But it's good for the rest of the wine drinkers, right? Then you can get cheaper Australian wines. Okay, number 6, last one, is China will realize the international economy environment is going to be more adversarial. Hence, they're changing strategy to what they call a dual circulation strategy. What is this dual circulation strategy? Very, very quick. Again, very quick. I'll just show you a couple of this slide. I just show you this one. Promise I just show you this one, then I'll move on, right? What it means is they're going to focus more on DC, domestic circulation. Dual strategy means international circulation, domestic circulation. They're going to rely less and less on international and more on domestic, okay? So it's a hedging strategy. But that doesn't mean they're going to give up exports altogether, but they realize they need to develop the domestic economy even more, okay? Okay, just leave it at that, okay? So what are the 3 areas that they need to focus on? Food, energy, technology, right? So that's to secure the strategy. Yeah, I just show you one more slide, then I'll move on. Keep an eye out, or have an awareness also on China's political calendar, okay? I'll put out some dates here, see if you can remember what are the key significant dates here, okay? 2017, the 19th Party Congress. 2018 was the 40th year anniversary of the opening up of the Chinese economy, 1978. 2019 was the 70th anniversary of the founding of the People's Republic of China. Wow, 70 years already from 1949. 2020 was when China said we would be a moderately prosperous society. Now, this year is a very, very important year for China. Why? Because it is the 100th anniversary of the founding of the Chinese Communist Party, right? In 1921. So they're going to have an anniversary this year to celebrate the Chinese Communist Party. Then 2022, the 20th Party Congress. 2022 was meant to be the year that Xi Jinping serves his 2nd term. End of 10 years, they're meant to rotate to a new president, but he's going to stay, right? So then 2035, they want to be moderately prosperous society, and by 2050, they want to be a great power. And this is what the Americans will be worried about. That great power means you're going to be number 1. America means we're not going to let that happen. Okay, so that's China's perspective. What about the US perspective? Okay, the empire, right, strikes back. President Joe Biden's first and foremost priority is domestic, right? Like it or not, it's still a very divided America. Almost 48%, 49% voted for Donald Trump. So it's still a very divided America, very hard to govern. That's why his whole energy is really to inoculate the domestic population before worrying about the outside world, is to get the economy back on its feet again, okay? In the commencement, in his inauguration speech, he basically mentioned the word unity almost 11 times, right? Number 2, right? America needs to come up with a national China strategy, okay? America also needs to come up with a coherent foreign strategy, right? Have you heard this phrase, Indo-Pacific, to bring in India into the Pacific sphere, right? So number 4, America also wants to come up with a strategy. How are they going to deal with China's strategy towards its allies, like Australia, right? Like the punitive and more sort of harsher actions on its allies. So US needs to come up with such a stance as well. Number 5, okay, the bottom line is that they know that China is a strategic competitor. So they need to have a more coherent policy, how to deal with it. Now, the good thing is, I'm going to show you a few pictures. Do you recognize any of these guys here? Right? Because these guys are in the old administration under Obama, and they are now in the Biden administration. In other words, or some of them anyway. Now, in other words, they're very skilled, experienced people. They're not novices, okay? Here's Jake Sullivan, former advisor to Hillary Clinton. Here's a general, Lloyd Austin, Catherine Tai, who's a new the trade representative. Here's Mr. Blinken, Tony Blinken, who is now the Foreign Secretary of State, Secretary of State. And here's Kurt Campbell, the man who came up with the pivot to Asia strategy. So don't worry about them. I just show you just for out of interest. Okay, so let's finish off. Say for where are the two places where the two guys can cooperate is really in climate change, in pandemic responses, and really both sides need to know where the red line is that you must not cross. Okay, let me summarize it with this picture here. Okay, how many of you have watched the play called Hamlet? Okay, Hamlet is a very difficult character to play, right? So people often say the only way to find the best actor is let everybody play Hamlet and let the best man win. You know, another way to say it is that let 100 flowers bloom and let 100 schools of thought contend. What am I trying to say here? What I'm trying to say is that both the US and China know they're going to be more adversarial. There'll be a place for competition. So the best way, let them compete where they can compete, right? The two sides will say we need to compete in certain areas. So let 100 flowers bloom. Let 100 schools of thought contend, meaning that we have differences. Let's not touch those areas, but where we can compete, let's compete in that and let the best man win. Basically, it was what they're trying to say. Okay, let me summarize it by this. Okay, let me show you traffic lights instead. Easier to understand. Okay, there are red lines that the two sides must not cross. For China, it's Taiwan, right? US, maybe it's human rights, other areas, okay? Then there are green lines where both sides must compete. What are they? Global pandemic control, climate change, because these are the two biggest economies. If they don't agree on climate change, the rest of the world won't make any difference. Then there's a yellow line, yellow area, where both can compete, right? And let the best person win. And this is basically what Tony Blinken said. Okay, one goes through it. Okay, last slide. Okay, risk number one is if the COVID strains continue to mutate, then the recovery will be even bumpier, right? Number two, if the Fed is too slow to act, you get overheating. Okay. Then number three, if the US-China tensions continue to escalate. Why? Because of maybe accidents between the two. Both sides cross each other's red line. Wonderful. So I'll stop share now if that's okay, Mike. I'll hand it over to you.
Okay, thank you very much, Mr. Charlie. Tracy, will you take it over?
Yes.
Please.
Now we'll move on to the next segment, which is the Q&A session. So students, please feel free to ask any questions in relation to Mr. Charlie's field.
Students, please turn on your camera while you're asking a question to the speakers, so we actually recognize who is actually talking. And if you are too shy, you can type in a chat box. We will read the question for you. It doesn't have to be like a core economic science if you're not familiar.
Oh, no.
Yeah. It can be any question that is related to the economic recovery after the COVID-19. Oh yeah, we will give you the recording, the shares later on, no worries. So while you guys are thinking about the question, why don't we start from the one of the teaching assistants, shall we?
Can I ask first, Mike? Sorry, because I have another meeting at 3.
Okay, please.
Yeah, hi. It's good to see you, Mr. Charlie Lai. My name is Marco Hermawan, and I'm the head of program for international business. I'm also teaching business in Indonesia, and I'm really interested in your insights on the global pandemic situation in regards to their GDPs and their economic progress. So I was just wondering, because since you were presenting all these facts, yeah, especially for those countries who are doing their lockdowns, yeah, and they kind of juggle between doing their lockdowns and maintaining stability of their GDP. But in fact, when they do the well, I mean, some of the countries are actually using their full lockdowns, partial lockdown, whatever lockdowns they provide to their countries. But the soonest they do the lockdowns, the better the GDP. Is that statement correct, or has there been any research in regards to that? Thanks, John.
No, oh, thank you very much for the question. Now, that statement is certainly true for certain countries. Right? You think about China. That's exactly the strategy that they took before the vaccines came on to the market, before the scientists managed to come with a vaccine. So the best way is really just to separate people. Don't have interaction until the virus situation is controlled, and then you can open up slowly. So whereas for the US side, what did they do? They basically took a more relaxed attitude towards it, don't need to wear a mask, etc. And then it got out of hand. But thankfully, you know, with the vaccines that was produced and the US was able to source a lot of them, they were able to inoculate a really quite impressively a big population of the percentage of the population. And now the economy, the US economy at least, is well on the road to recovery. So it all depends on whether you have the political structure like in China, where you can't get everybody to stay and obey the rules, right? I know, like here in Singapore, if you don't obey the rules, you get fined. So everybody will obey the rules, and which actually has worked out really well. So the government has also done a really good job in containing the spread. You know, 3 weeks ago, we went into like a heightened alert situation where we cannot dine in anymore. All the restaurants were still open, but we cannot dine in. And they took drastic actions because they needed to. They didn't want the situation to get out of hand again. In countries where you don't have that kind of strict control and you don't have the vaccine availability, then it's going to be tougher. Okay, so especially the country is a lot bigger. Singapore is quite small, so maybe a bit easier to handle. So I think I'll say, like going forward, there are probably two things that you really need now. Is really you need to hit herd immunity, and that really comes through vaccination. Okay, and before that, then you really got to lean on the cautious, conservative side, and really sacrifice a bit of growth in order to protect people's lives, because it's a bit of a trade-off, isn't it? Is economic growth or really people's lives? So livelihood or lives. It's a balance between the two. In India, the reason why this recent wave has really got out of hand is because they wanted to protect the economy. So to get the economy back on its feet, continue to grow, but then at the expense of really the catastrophe that we've seen now in terms of lives that were lost. Yeah, so
interesting.
We see, yeah.
Yeah. Thank you so much for the answer.
Wonderful, pleasure.
I hope that triggers another question for the students. Thank you.
There's a question from Ritz Fernando. They asked, what do you make of the Fed's moves so far? And what is the most important action it can take to help prevent a deeper economic collapse?
For the Federal Reserve, right? He's asking, what can the Federal Reserve do now? So you take a step back, so we're all on the same page. So in a sense, you can say, give a big applause to the Fed's actions in March last year. They acted very fast and very forcibly. What did they do? Cut rates back down to zero and embarked on QE almost immediately, straight away. As opposed, because they learned the lesson from 2008. 2008, they took a while to put into QE. This time around, no questions asked, go ahead and do it. What's the benefit? The stock market rebounded really fast. What's the downside? Income inequality, right? Certain people benefited a lot more. So that's why they say we want to keep rates low for as long as possible until we have full recovery. Now, the danger with that policy is you will overcook things. Things will overheat. And what's the risk of that, which is what the question is pertaining to? The risk of that is that when there is a correction, it could correct a lot faster. And then there could be even more damage. So think of it this way, like you're driving a car, eventually you will need to put your foot on the brake, right? Your car cannot just keep on going on the accelerator all the time. There will be a traffic light, but you don't really know when the traffic light will be. They will come. So maybe you're going on this straight road for a long time. Maybe it's better for you to take up your foot off the accelerator, let the car slow down a bit, and maybe slow things down a bit now, because you start to see the traffic lights ahead. Rather than waiting to the last minute, you see a red light, then you slam your foot on the brake, and then everybody gets a jerk. See, so it's maybe better for the Fed, the US central bank, to start to cool things down now, rather than let it sort of simmer and boil, right? So it's a bit like, yeah, I would say that's really the prudent policy that the Fed should do now. Okay, one last point. Last year, what the Fed did was put everybody in ICU, but now the patient is not so sick. In fact, the patient can walk around now, so don't need to be in ICU already. Can take them out, maybe put in the normal ward. In fact, the economy may not even need to be in hospital anymore. Can go out and start exercising a bit. So that's the picture, right? No more ICU policy. Can have more normal policy now. Thank you.
Thank you. Okay, so the next question is, can ASEAN countries economically bounce back after most of the people get vaccinated without having to worry or consider about the movement and decision from superpower countries like the US and China? Are there any possibilities?
Oh yes, certainly, of course, right? So if it can happen in Europe, in the US, definitely. If it can happen in Australia, New Zealand, it can definitely happen here. But the key is about hitting herd immunity, okay? Getting a majority of the population vaccinated. So what percent would mean herd immunity? Before, scientists would say maybe around 70%. But now, because of the new variants, right, you may need to be higher, maybe 75 to 80%. The danger is that the longer it takes to inoculate majority of the population, the risk of the virus mutating even more is going to be even higher. So the faster, the better. And that really has to be the foundation of your recovery, that you get rid of the health risk, and then you can start to address the supply side and the demand side, right? At the moment, it's fighting fire, it's damage control for the time being. Yeah. Thanks.
Okay, thank you. So the next question is, how will the market of trade change after the pandemic comes to an end? How can we prepare ourselves for the changes?
Changes for the stock market, is it? The market, which?
Yes, the market, the trade market.
Or the stock market, is it? How can you protect yourselves from the stock market? Well, the fact is that the Asian markets probably hasn't gone up that much, right? But the US developed well, definitely. In Europe and the US, definitely gone up. Like the Dow Jones, the S&P 500 is almost like near record levels. So I guess with all this, it doesn't harm to take some money off the table, right? So if you have profits already in the market or whatever stock you invest in, it doesn't harm to really reduce a bit of risk. Because think of it this way, because it's always going to be a cycle, right? And now the cycle is towards the peak. So say it's a 1 to 10, 10 is at the peak of the cycle, 1 is at the bottom. You're probably like towards 7, 8, 9, 10, towards the upper end. If you made a lot of sitting on a good profits already, so maybe it doesn't harm if I take some money off and really just be on a less risk kind of investment sort of side now, because you can't time it. You never know when things will crack or when things will really drop. So it's really a season to be prudent, put it that way. Yeah. hopefully that addresses the question.
Mr. Charlie, do you mind spend like another 10 to 15 minutes because we have hundreds of questions to answer?
Sure. I'm fine. Yeah.
Sure. Tracy, can you continue from the third question, I guess?
Yeah, sure. Okay, so do you think crypto will ever have a place in banking?
Do I think there is a, let me see the question.
Do you think cryptocurrency will ever have a place in banking?
Oh, I see. Currently, difficult to see, right? Because it's still viewed pretty much as a speculative asset with not much backing. The central banks are still questioning the viability or legitimacy of it. But the technology behind cryptocurrencies, right, behind Bitcoin, all this, what they call the blockchain technology, maybe that is here to stay. Okay. Point number two, the central banks are also thinking about creating their own digital currencies. So then in that sense, say, yes, maybe it does have a place, but for the time being, it's not really in a mainstream or investment. So if you were to like go to a bank and ask your relationship manager, can I buy Bitcoin? Your bank, your relationship manager will probably have to say, our official stance is that it's not an official asset class, right? If you want to buy, feel free, but only on your own directive, right? Not as a bank recommendation, because I think very few banks will officially recommend that at this stage, okay? But longer round with the central banks wanted to come into this space because you need regulation, okay, in order for it to become a bit more sort of mainstream. So at this stage, it's still seen pretty much more as a speculative asset rather than in a mainstream sort of investment asset class. Yep.
Okay, thank you for that. Next question is, what do you think are some notable bad examples to avoid of how various governments try to salvage their economy in the wake of COVID-19? I've heard of several attempts to start up the economy that lead to major backfiring for the country that enacted set policies and actions.
Sure. Yeah. So I guess what you're asking is really about the policy missteps of various governments, right? And of course, the one that you can think of is really that you were too lax, or if governments were too complacent about this virus, about this situation. E.g., what happened in the US under ex-President Trump before, right? That this is just a flu, will just go over. And then it did not, right? It spread. So really complacency. I think most countries here in Asia, we took it rather seriously, right? And then beyond that, it's really to maintain vigilance. If you were to relax too fast, too quickly, and then things can easily get out of control. What happened with, like, say, with Malaysia, even to a certain extent, like Vietnam. Vietnam was really one of, even Taiwan. Vietnam and Taiwan were the poster childs of how governments have handled the COVID really, really well. That did not even need to go under any lockdown last year, both Vietnam and Taiwan. But because of complacency, right, you let your guard down, and then the new variants, the new mutations will come in, and now Taiwan is a lot of cases spiked up in just the last few weeks. So then it's really scrambling. So it's really remaining vigilant. I guess I can say one more thing besides those are, you can look back and say, yeah, there's a common sense thing. But even in terms of stimulus, then it's really, being targeted. Which are the sectors that really need help? Which are ones that maybe not? And really using this opportunity. So that's right. So targeting support, because you need the support. Then number 4 is really think long term, right? It's not just for the here and now, but how can I retool, retrain my population, my populace, my working age population to equip for a post-COVID world. And that's why you guys are in the right environment in getting an education, right? Now is really the environment for you to retool, upgrade your skill set to prepare for a post-COVID world, which will be driven by what? It's going to be driven by technology, AI, robotics, your 5G, your Internet of Things, 3D printing, right? Autonomous driving. So there'll be massive job destruction and also new job creation. So it's really about retraining. So that's how you should think, say, for as an individual, and for governments also think like that corporately, collectively. Yeah.
Okay, is it true that not all countries, especially big countries with huge population, such as the USA, India, and Indonesia, is it true that those types of countries are suitable to implement lockdown policy like in New Zealand and instead destroy the economy even worse?
Is it true that they been reluctant, is it, to lock down their economies?
Yeah, I think so.
Yeah, it possibly true because it's a lot bigger than New Zealand or even Australia to that extent, because it's a lot more diversity. So it's harder to handle, and the cost would be a lot more too, sure. Because every day, every week, the longer you lock down the economy, the government has to step in. You know, with the government stepping in, it's basically the government is paying the price, right? But you know, eventually, that price will be passed on to whom? If the government runs out of money, who will get the money from? Taxpayers. So eventually, there'll be higher taxes. So it's going to, the burden of this pandemic, the longer it drags on, is going to be via higher taxes, higher debt, be put on taxpayers. And then it's about the distribution. Who's going to pay this tax? Well, you say maybe the rich should pay more. Then it's going to be even more difficult to really push through, right? So, it is sure. I will agree with the statement, with the question, but it's really a matter of everybody working collectively together to see how you can minimize the damage until the vaccine sort of come to inoculate your population where life can go back to normal. And normal is going to be a new normal, right? It's not going to be like the pre-COVID world. You know, some people even say you may have to be wearing masks for many more years to come yet, right? Even if you're vaccinated. Unlike in the US, the CDC has said if you're vaccinated, you can go out without a vaccine. So next, without a mask, right? If you've been vaccinated. But you would think that in a post-COVID world, like airlines, cruises, everyone will probably require you to show a passport, that you have a vaccine passport, that you've been vaccinated before you can fly, or before you allow you into the country or something. So things like that. Thanks. Yeah.
The next question is pretty similar. Is the announcement of does the announcement of COVID-19 vaccine have any impact on the outlook of economic recovery?
The announcement, not so much the announcement, but it's sourcing for the vaccine, right? So now it's not just about whether, well, for the poorer countries, it's also a matter of whether you can afford it, right? It's not just, but it's also about supply. So even if you want to buy, there's not enough supply. Global production is just not meeting up to demand. So for the poorer countries, what IMF and these other global institutions have come up with is what they call COVAX, right? The joint agreement where the richer countries will donate money to it to buy the vaccine to donate to the poorer countries. So that initiative, you say, probably have to be even enhanced even further, because you know what we said earlier on? No one is safe, no country is safe until everybody is safe, because the vaccines will not respect borders, country borders, right? Humans are humans. They're going to transmit one to another. So the only way to stop the mutation is to stop the replication of the virus.
Okay, so Edward Gunawan asked, Mr. Charlie, you said that the poor are getting poorer and the rich are getting richer. How about when the pandemic ends? What happens to the poor? Are they going to get jobs instantly after the pandemic ends? Or how long will it take for the economy to be restored in order for the business to create space for employment? Next, will businesses have a sudden rise after the pandemic ends?
If the businesses have a certain right, is it? Well, like all things, see, when you study economics, like all things, the answer is it all depends, right? It depends on a lot of factors. You don't know. But let's bring the question down instead. Say, how does it relate to you, as young people, right? Oh, you guys are young, energetic, you're healthy, you still got many more years ahead of you in the workforce. The best way for you to do is really invest in yourself, invest in your education, upgrade yourself, develop the skill set that you need to live in a post-COVID world, right? And that's the best way, even for those who lost their jobs, even the lower income groups, to come to the next bracket is really increase your value. What value do you really bring to the table? So, so in a post-COVID world, governments need to play a bigger role, right? And maybe need to be more to retrain the people. There needs to be more spending on public infrastructure, on public healthcare, public spending on hospitals, more public spending, grants to virology research, so that you can handle the next pandemic. What's the danger? You guys all know, right? Everyone would say, this is not the last pandemic. There could be another pandemic that's going to be even more devastating than this one, right? Even more. So how are you going to protect yourself? Really, it's really just about your education. How and what industry do I really need to go into that will be able to sort of safeguard me, right? Yeah.
Okay. Daryl Sodojo asked, will rising government debt and deficits cause hyperinflation, the collapse of dollar, or worse?
Would the rising money printing, right, cause inflation?
And government debt.
Yeah, and government debt. Yeah. Well, that's the big debate going on now in the finance world, in the economics world, right? That there will be no free lunches. Eventually, you will need to pay a price for all this debt that the governments are piling on, and the increase in money supply, etc. It's just that at the moment you're not seeing so much of that, but there are worrying signs like commodity prices, lumber prices, tin prices, copper prices, right? Even oil, all going up. So there are definitely signs. So logic will tell you that there will be a price to pay. So that's why we said earlier on, in response to one of the earlier questions, is that maybe this is not the environment for you to really be so gung-ho and just invest and just throw everything in and all in, right? Because the markets have gone up so much that there is a risk of it sort of correcting or at least normalizing.
Okay, I hope that answers your question. Why do governments like to hide real figures of COVID-19 cases? Does it have something to do with the country's GDP?
Well, why do they want to hide? Is it COVID cases?
Real figures.
Well, we're not sure. We really don't know. Maybe they're not trying to hide. It's really just under testing. All this is also depends on the amount of testing that they do also, right? Yeah. So that one we're not sure. We don't know. So yeah.
Okay, next question. Do you think more windows of opportunity for green economy will open post-pandemic?
Oh yeah, of course, right? So that's where the whole debate is moving towards. What caused all this virus, even mutations to come in the first place is that you're not looking after the environment well enough. You're upsetting the whole ecosystem here. So, but even before COVID, the whole theme about ESG investing, or the whole theme about companies needing to be more aware, or governments aware of ESG, right? Being environmentally responsible has already been a major theme. So it's only going to get louder and louder going forward. You're going to move to a more green, sustainable sort of world. Yeah, definitely.
Okay, Fabian asked, we say that during COVID-19, a country is fueled by tourism would really have to think going forward how to retrain their populace and try to learn other sources of economic growth.
Yeah. Very true, very true. So that's the right way to think, right? So those countries which are very dependent on tourism. So who are they in Asia? Your Thailand, Indonesia maybe to a lesser extent, right? Thailand, Philippines, um, even Singapore to a certain extent. What are you going to do with these people who are not with not much job? People in the airline, people used to be your pilots, etc. Then you need to create opportunities for them to retrain them, but they themselves need to think like that as well, right? How can I reinvent myself in a way? How can I retool myself, for a post-COVID world? Yeah, but you can't wait. It may take, tourism will take a long time before it returns to pre-COVID levels. Yeah. Yes. So, wow, we've gone through a lot of questions.
Yeah.
Just
what do you
two more last questions. Yeah.
Okay.
Yeah.
Yes. What do you think about proposals to expand the International Monetary Fund lending by issuing more special drawing rights?
Sure. Yeah. So your SDRs, right? Your special drawing rights. That's part and parcel of the global institutions, the richer countries, the developed countries, come with some sort of scheme to help out the developing countries. All with the idea of what? All with the idea that no country is safe until everybody is safe. You need to pull everybody up along. It's just that with President Biden's approach, he had no choice but to look after the domestic population first because of the divisiveness of America. Okay, so that was the strategy short term. Then you need to expand on that. So with the SDRs, with IMF, encouraging richer nations to donate to COVAX, to donate to the IMF fund, whatever it may be, it's all part and parcel of that to really pull the rest of the economy up along with it. Yeah, which is also a good thing, because what that means is it's inclusivity, right? It's inclusive growth, because the whole idea about globalization in the last 70 years is that some people benefited a lot more than others. So globalization in and by itself is not evil. It's the distribution of the fruits of globalization. Maybe it needs to be distributed a bit better, rather than just 80% of it going just to 20% of the population. Yeah.
Okay, last question. Do you think post-COVID that major economies will continue to downplay and ignore human rights violations in favor of economic growth? Will the pandemic and its subsequent economic vulnerability have changed anything on this front?
No. I think it's very true, right? In the post-COVID world, the whole sense about accountability, right? Accountability to one another in terms of reporting on any signs of another potential pandemic, right? Because you know what the scientists are saying all the time, right? That this is just a forerunner of what is the biggest super pandemic that's to come. So accountability to one another. So if you notice anything going wrong in your country, it's your duty to report to the wider community, right? Accountability to the environment, that we need to protect the environment even better, your CO2 emissions. So that's why there's a lot of pressure on companies listed, on investing, and on responsible investment, responsible growth, right? It's not just about GDP for the sake of GDP. It's about GDP and also protecting the environment. So I agree with the question, definitely. There will be a lot more accountability that's going to be placed on each country, not just on developing countries or even those who abuse human rights, but really for everybody, for the rich and for the poorer. So remember what Joe Biden did, right? In his first few days in office, he basically took the US back into the Paris Accord, just as a signal to the wider world that we indeed do believe the threats of climate change. Yeah.
Okay, so unfortunately, that's all the time we have. Thank you once again, everyone, for your participation, and Mr. Kim and Mr. Charlie for leading this event.
Thank you. Well, I was planning to do some moderation as a panelist, but since there were like bunch of questions, like almost 15 questions from the students, so Well, I also had a few questions for Charlie, but well, we will do it in the next time. Once again, thank you very much for your time during this busy time. Please give him a big applause before we finish the sessions. And then we will actually take some photo. And if you have any last word, Charlie, to our students during this pandemic, I'm pretty sure they are having some issues at home, feeling more anxiety or unstable mentally, because they are also trying to having a difficult moment to get a new job, because there are many jobs has been removed and eliminated. So we are in ASEAN countries, not in the US, right? So basically, I'm pretty sure that most of the students are quite worried about the future. So before we finish the session, just a quick last word for our students.
Oh, you stay calm and you carry on, Ken. You keep on investing in yourself, right? So you don't give up.